On this episode of Something More, I'm with Brian Regan. We're talking about markets and fears, the dollar dominance and earnings. What's driving markets today?
Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome to Something More with Chris Boyd. I'm here with Brian Regan. We are both of the AMR team. Glad to have you joining us. Lots to talk about today. I think we've been getting these questions. This is not unusual. We get, sometimes it's a Facebook video, sometimes it's a email, newsletter, promo, all these things that play on fears that people have. So I thought we might touch on one of these that we got recently and just elaborate on. Are these fears you should have or not? And there's a variety of them that come through routinely. These days, there's lots of things that people are worried about. They're worried about a crash. They're worried about dollar dominance. They're worried about the government debt. They're worried about inflation. There's so many things. So we're going to talk about some of those. But before we do, Brian, you were saying there's a lot of really good news today in particular, based on a recent earnings call. Tell us about that.
We got the conference call. It was much anticipated conference call from NVIDIA last night. And it was the best, probably the best conference call I've ever heard in my entire life. Not only, are they growing north of 60% as a $5 trillion company. They gave guidance they gave guidance for all of 26 to the tune of $500 billion in sales. So $500 billion in sales, just unbelievable.
Wow.
They said they expect the hyperscalers to spend closer to $600 billion in 2026.
Wow.
They spent about $450 billion here in 2025. The numbers are staggering. The press release says the AI GPU chip sales are off the charts, and that's their words, not mine. But it's true. And not only that, they're selling these things at 75% margins. When was the last time you heard of a hardware company selling anything at a 75% margin? They got software-like margins and sales that's almost hard to believe. If you weren't getting confirmation from all their biggest customers at the same time, I don't think I would believe it. I would say it's too good to be true, but it's just shocking. So the market's up nearly 2% as I speak this morning. And I think a lot of those fears have been pushed off into the future, at least with the anticipation of an AI bubble. The talk of an AI bubble, which was in a bubble, popped. So this is great news for the market. For one thing, when you're investing in anything, is you don't know the future, right? And when the biggest company in the world can come out and tell you that they have pretty good views on the next 12 months, and not only that, but their view is a $500 billion number in sales, that's the most you could possibly ask for, right? We talk about the consistency and growth. What's better than that? The fear is that, of course, they're going to overbuild and the cost of compute is going to come down, and a lot of these data centers and the people funding them,
that's a good point.
We'll get stressed financially, and that's I think that's almost inevitable. It's part of the animal spirits of the United States, right? We're going to build as long as we think there's an opportunity, and if people are buying, you're going to go into debt to supply the product until there's too much of that product. It's kind of a classic business cycle. But I don't think there's any. I think we got confirmation that there's no signs of that right now.
It's incredible. That's fabulous. And that's good news for investors that who've had this worry. Are we toppy? Are we worried about things slowing down?
And then the kicker on top of that, we got a jobs report today. We haven't had one in a while.
Yeah.
Because of the government shutdown. And it was a banger number, 119,000 jobs added. We were expecting flat to negative, and that's a solid number. I mean,
Yeah.
There's a lot of caveats in that, and one data point certainly doesn't make a trend, but that's good news to me.
One of the things people worry about, it seems, when it comes to the whole AI story is the energy implications and the demands that it has for that, and how that will be satisfied, whether that will affect rates for consumers. Talk to that issue and how that's being addressed, and what's your crystal ball sharing with us on that today, as far as what do you think's going to happening there?
I don't have a crystal ball, of course, but what I think is going to happen is the compute per watt is going to continue to decline. I say continue because with each iteration of let's just talk about what NVIDIA talked about last night. With each iteration of their product that they've produced, they've been able to get more compute power per watt of energy. So
more efficiency, essentially, then, huh?
Yeah, there was of course, they use more energy because they're adding more and more tokens, right? Yeah. But if you get more and more efficient chips, you might solve that issue in the data center just by getting more and more advanced chips. And I think that's the hope and part of the reason why you're seeing NVIDIA with $500 billion in AI sales in 2026, where to my knowledge, no other company is coming anywhere close to that number.
Explain to us NVIDIA's role in all this. Do they provide the technology, the software that is in these chips, or do they actually create the hardware?
Both. So this is something that's very important to understand, because the way I've always evaluated these things is that software dominates. Okay, so that comes back from, like, if you go back an analysis of IBM, what happened between IBM and Microsoft, and then even Compaq and Dell, the hardware providers kind of fell to the wayside, right? They became commoditized, and the software producer became the standard bearer across all PCs, and it ended up dominating for, Microsoft still dominating.
Yeah.
So when evaluating the AI landscape, the software provider became very important to me. And it's one of the things that made me think that the big winners were going to be the cloud providers, because the cloud providers can build their own software that app developers can build on. Now, there is some of this going on, and if the cloud computing companies, which are, the hyperscalers, for lack of a better word, really Microsoft, Amazon, Oracle, if they build their own thing, they can diversify the types of chips they're going to use. So that's all well and good, but the standard so far is NVIDIA software. So they're loading a program called CUDA onto these chips. And we say chips, and I think people think of like a little, microchip that's in your PC. Yeah, these are really they're really servers, right? They're big computers at this point. They run a program called CUDA on it, which helps you do the pre-training, the post-training, and the inference for all these LLMs. So they have a dominant leadership role in both the hardware and the software, which I don't have a parallel for. I mean, that's pretty amazing. It would be like if Microsoft also had the dominant PC. I guess in some ways it would be, Apple was a good kind of closest thing, but they didn't have anywhere near the market share, right? The Apple computer, the Mac, never became the standard in PCs. It's widely used, as we know. They did become the standard in mobile. So it'll be interesting to see how this plays out over time, and it's something that you need to continue to monitor. But nothing but good news. I'm actually surprised the market's not up more. Just an unbelievable phone call.
Very good. Well, thanks for sharing that. Let's talk about some of these recurring things that play on people's fears. We see these routinely. I mean, you and I, we've been doing this for a while. We've seen this with particular clients who get on a mailing list or an email list, and they're particularly susceptible to all these come-ons, I'll call it, because they're trying to sell a book or sell gold or sell, some alternative way of doing things, or a newsletter or something. But in this case, I had a client share a video that, obviously it spoke of a variety of concerns. And, my impression was it created some anxiety for them. And they were saying, hey, help me navigate this. So I suspect these kind of things get presented to people all the time, and it gnaws at them a little bit. And so I thought, let's try to demystify some of these a little bit. So one particular one that, gosh, I hear a lot is this question of the dollar's dominance being eroded, and is this something that's imminently problematic? That we do see China trying to do business, Russia trying to do business outside of the dollar, because of course that we've tried to use the banking system to try to create problems for them, to punish them for activities that we consider improper or undesirable. So there is this move to, we see it for China paying for oil outside of the dollar, right? Things like this. So is this something that's imminently problematic? What's the percentage of activity that's done in the dollar as a maybe I don't have to know offhand, but in ballpark of all the transactions that happen in the world? It's
So
huge.
this isn't an issue at all.
Yeah.
And I'll start there. I always tell my wife that she buries the lead, especially when my kids go to the doctor. So I'm not going to bury the lead. This is a
Don't worry
non-issue.
about this. Yeah.
Yeah. So
Will could it someday be an issue? Maybe. That's not.
Yeah.
But it's a long way off before that's something to be worried about.
I'm going to address your question, but I have a little preamble on getting information on social media before I do that. So don't get your information on social media. That's it, right? Like that's the main sentence. The video that I was shared, I wrote 2 articles on LinkedIn based on the same Wall Street Journal article. One of them was why people are stressed economically. It was a pretty negative article. It got 4 times as many opens and reads than the positive spin I put on it afterwards. So that's all you really need to know about how your social media feed is giving you. It's gonna serve you people who are preying on your fears. So with that, I'll try to answer your question. The overwhelming amount of international transactions are still done in the dollar. It is true that there is a decline in treasury bank assets, central bank assets, particularly in countries that you might consider foes. And this started more heavily during when we cut off access to the SWIFT system with Russia when they invaded Ukraine. So this essentially made it very difficult or impossible to get the dollars that they had in central banks across the world. So they resorted to other things. Excuse me, I'm fighting a cold. They resorted to other things. Most notably, they started buying gold. And that's part of the reason why we've seen a big gold run up in the last few years. But no, I don't think this is an issue. I think this is mostly preying on fears of people with a kernel of truth, which I think is pretty common. The other part of that article, Chris, was the erosions of the rule of law in the United States, and I actually think this could be a real problem, right?
Yeah.
Me and you and Jeff often talk about things and how it might affect the markets, and usually in the past you had you had a good guidepost. You say, well, that's illegal, like it's not going to happen. So if the market goes down based on that news, you knew it was a buying opportunity,
right?
But now one party controls both parts of Congress and the Supreme Court. So there's just an overwhelming amount of power in the executive branch. And the reality is that overwhelming amount of power needs to be checked, or the laws aren't really that applicable. So this is a real concern. You have less assurance on what the outcome of certain events is going to be. Now, despite that, the markets have done very well. So they've seemed to have brushed this, let's call it political event, where things might change in a year, things might change in 3 years, and the market's looking through that, and they're concentrating on things like unbelievable earnings from the AI part of the market, which I think is the more important thing to focus on a day-to-day basis. One of the things that you need to remember about the U.S. political system, at least today, is that we have elections every 2 years, which can reshape the government. And stocks are long-term assets. When we evaluate and we value stocks, we look at the 10-year treasury. We don't look at the 2-year treasury. So a lot of these fears that people might be latching onto might just be looked through by the market, and it could be confusing to the average person.
So it's one of these situations where we as a society, we have to be ever vigilant, right, when it comes to the enforcement of the rule of law, because it affects us all, right? And it can impact the desirability of people willing to invest in the United States as compared to other options.
The tariffs are a good example of that.
I was just going to go there. This is a little political in our nature, but in our conversation. But tariffs have been one of these issues this year that have created tensions with other parts of the world. How has this impacted, or do you envision this as having a prolonged impact in any way on how others view investing in the United States? And how has this maybe impacted the dollar with regard to treasury investments as well?
Look, it's no coincidence that we saw the dollar decline after the April 2nd. That's no coincidence in my mind. So what does that mean? Foreign buyers are buying less treasuries. Bottom line, we're seeing that in terms of central banks. They've had a preference for gold. Whether that's a long-term problem, I don't think so. When it comes to tariffs, to me, they're obviously illegal. This is a good example. It's before the Supreme Court right now. The Supreme Court, which has let's just call it President Trump bias, because many of the justices were appointed by President Trump. We're at least asking some very, very hard questions to the administration's lawyers, right? So, it's so illegal that even the biased Supreme Court may reject it, which would be a good thing. The power to tax lies with Congress by the Constitution. It's very clear. To me, this is cut and dry, but it's a great example of how do you act on that, right? It's a gigantic drag on the U.S. economy, and we're seeing it increase inflation. We're seeing it affect certain sectors, and I think it would be great if the Supreme Court did the right thing and struck these down.
Let's talk about topics that are other common fears that aren't necessarily these, prompted by a video or something, but we've got worries of inflation, concerns about borrowing costs being higher. You talked about some of these in our recent video for clientele, our webinar, and this is, by the way, available on our website or on YouTube if you want to see Brian's most recent economic and market outlook. What can you tell us about some of the challenges that are occurring within the economy today? Student loan debt rising, the challenges of buying a home even. How is this working into the economy? And is this something investors should be paying attention to and have as a concern?
Yeah, I think those are interesting issues. They're not necessarily related to tariffs like we were just talking to, but student loans and home buying and car buying, I think, are very much related. It's very hard to try to find data on this, so I wish I had some more facts, but you can do some common sense analysis, right? So between 2020 and 2020
might have been my tie-in with the tariffs in my mind there. I guess that was probably where I tried to connect those dots.
Well, in the webinar, I put them all together, right? They were part of things that were drags on the economy. So
Yeah.
But I think student loans might be maybe being overlooked and how it's affecting, stocks like CarMax. They just fired their CEO, the stock's down 50% this year. So between 2020 and 2024, people did not need to pay their student loans. So what did they do? They paid down other debt. They improved their credit scores. They bought cars. They bought houses. We saw rapid inflation in those areas, right?
Yeah.
Now we're seeing, as people need to pay their student loans again, you're seeing default rates go back up to the historical norm. Nothing crazy outside the historical norm. But when you go from 0 for 4 years to, the historical norm of 10% with 4 million people, 4 to 5 million people getting hit on their credit scores by 150 basis points, 150 points. I say too used to saying basis points.
Lingo,
FICO points, right? So let's say that
it's a big hit.
Let's say you go into this with a 720 prime borrower, doing well, able to buy a house, able to finance a car. You miss your student loan payment, you go down to 570, you're subprime. You can't buy a house, you can't buy a car. What's going to happen? Well, what we're seeing is there's not people aren't buying cars, right? At least not used cars.
Slow down in these kinds of possibilities. Yeah.
So new cars are, doing okay, I'd say, but the used cars market is in trouble right now, and I think this is a big part of it. You can agree or disagree, but from anecdotally, it certainly seems like the housing market is correcting to me. I live in the Northeast. Supposedly, this is one of the better markets in the country, and I'm seeing nothing but price declines. People or houses sitting on the market for a long time. Yeah. And we all know between 2020 and 2024, if you tried to buy a house, there was a line out the door at the open house, and you were damn lucky if you got an offer accepted that was waiving contingencies. So to me, the housing market's cooled, the car market's cooled significantly. Maybe not to the degree that make it possible for people to buy, but this in a liquid market like the housing market, it takes time. Like, how long does your house need to be on the market for you to cut the price? 30, 60, 90, 120 days. It depends, right? If you have a 3% mortgage on that, or if it's paid off, you might keep it on there until the market turns. You might wait for the spring market, right? And at least in Massachusetts, there's basically, the house buying tends to start in April and it ends by August because you kind of want to close before kids go into school. So, it might be a function of that as well, but we're seeing it across the country that this is the case. And I do think it's one of the drags that we're having on the economy right now, which importantly is being offset by this boom in AI.
And that's maybe an important perspective. So you've talked about this, that there's sort of these two ends of this story, one being, some of the challenges that we face, but at the same time, there is this very favorable economic impact and obviously market benefit, the AI story and how it's playing out.
There's this great chart we have in the webinar where we show the decline in building for office buildings and the increase for data centers. And they're almost a 1-for-1 change. So if you were banking on construction workers losing their jobs across the country because we were going to build less houses because of less demand, and we were going to, build less office buildings, well, that's been offset by this AI economy. And I think it's important not to focus on one or the other because they're both important, right? There's a yin and a yang, and I find that people struggle to put both sides of that economy together, and it is a struggle. But
because it affects different people in different ways.
we have an individual stock portfolio with the AMR team here at Wealth Enhancement, and I noticed that we tend to outperform if AI is kind of not as in vogue that day, and we underperform if it's in vogue. And why is that? Because NVIDIA is 8% of the S&P 500. I don't have an 8% position in anything. So, that's, and because I have this yin and yang in my brain, right? So when things are going really, really well, we'll do well too, but not as well. And when things in the AI, tend to ebb, we might actually outperform on the risk adjusted side. So, you know, an interesting way of how this view is expressed in our individual stock portfolio and how it actually affects day-to-day performance and volatility.
Well, I think we should at some point have a follow-up conversation about AI. In one of the things people worry about is how will this adversely affect, disrupt the workforce. But is there, again, the yin and yang of that? When there's disruption, there's also new efficiencies. There can be new opportunities in terms of where there's job opportunity as well. So it's one of those things people worry about. Will this put people out of work? But it may also create some opportunities that people can even, maybe even conceived of yet.
Well, we don't know much, right? But we do know a few things. It is going to put people out of work.
Yeah.
It's not going to happen like a light switch. It's going to happen gradually. And hopefully those folks will get retrained doing something else over time. I don't think that's as easy in the world these days as maybe it was in prior technological changes. It doesn't seem like much of a desire to actually retrain people in the workforce these days.
Yeah.
But
that way. Yeah. Yeah.
Every major technological change has come with more productivity, more growth, and more jobs. I hope that's the case. If you listen to Elon Musk, he thinks that we have a future of optional work. I don't know. It sounds great, I guess.
Wouldn't that be nice? But yeah. Well, to be discussed more fully another time. With that, Brian, thanks for sharing some insights, both a little bit of optimism, I would say, with a dose of realism. We've got our challenges. There are these issues. We hear from clients about certain concerns. Thanks for putting a little light on that. But also this really encouraging news in today's market that maybe helps people feel a little bit easier about the question of a bubble when it comes to the AI story. With that, if you need help with thinking about your portfolio, you need a second opinion, you want to talk about right sizing some of your positions, maybe you have some tax challenges that you're dealing with. If maybe you're just dealing with, hey, I'm not sure I want to be the one who deals with this as the prime decision maker. I'd like to delegate some of this work. See if we're a good fit for you. Certainly come in for a complimentary consultation. We're available to you whenever it's desirable. We'd love to be a help as you go into a new year. It might be a good time to be thinking about a conversation with getting some assistance. Until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.